Welcome, professionals. Today we embark on a masterclass exploring the lifeblood of global commerce, the dynamics of global money movement. Let's get started. Welcome to this session on the dynamics of global money movement. In our modern economy, the term treasury implies managing the lifeblood of an organization, its money. But how does this money actually move? Today, we will transition from traditional physical forms like currency and checks to the sophisticated realm of electronic funds transfer. When a corporate treasurer needs to move millions across borders, they don't use physical cash. They rely on vast, interconnected electronic banking networks. Why does this matter? Because inefficient money movement creates float, the non-availability of funds due to transit or procedural delays. Float costs companies millions in lost interest. In this training, we will dissect the architecture of these payment systems, giving you the deep domain expertise required to optimize global liquidity and mitigate financial risks. This flowchart illustrates the evolutionary mechanisms of money transfer. We start at the top with global money movement, which branches into physical exchanges like currency and checks on the left, and modern electronic funds transfer on the right. Notice how the digital nodes act as accelerators for global commerce, flowing directly into our ultimate objective, reduced float and enhanced corporate liquidity. As we dive into the mechanics, we must clarify two terms that are often incorrectly used interchangeably: clearing and settlement. What is the difference? Clearing refers to the entire end-to-end process of receiving, transmitting, reconciling, and confirming payment orders. It is the information flow. In many cases, clearing includes the netting of instructions to determine the final amounts owed. Settlement, on the other hand, is the actual, final discharge of the payment obligation the moment the funds are officially transferred and recognized. Understanding this separation is vital. A transaction can be successfully cleared but fail to settle if the paying bank lacks sufficient funds. As a treasury expert, you must design your cash concentration and disbursement structures around these systemic realities to ensure your company's liquidity is never compromised by settlement failures. Look at the sequence diagram on screen. It visually separates the two distinct phases, clearing and settlement. First, the payer bank initiates the instructions, which enter the clearing phase at the clearing house for reconciliation and netting. Only after clearing is finalized do we move to the settlement phase, where the central bank actually debits and credits the respective accounts, transferring the final value to the payee bank. Domestic electronic funds transfers are generally divided into two main categories based on transaction size: high-value and ordinary-value payments. High-value payments utilize real-time gross settlement, or ARTGS systems. In an ARTGS system, payments are processed immediately and settled on a gross basis, meaning each transaction is settled individually, not netted. This is used for urgent, large-scale corporate transfers. Conversely, low-value payments rely on automated clearinghouse, or ACH models. ACH systems process large volumes of transactions in batches, and settlement occurs on a net basis at specific intervals. While ARTGS provides instant, risk-free settlement, ACH is a much more cost-effective solution because the transaction cost is spread across thousands of grouped payments. Treasurers must strategically choose between ARTGS and ACH, depending on the urgency and volume of the company's payables and receivables. This split path diagram contrasts ARTGS and ACH systems. On the top path, high-value transfers route through the ARTGS system, processing payments immediately and individually on a gross basis, providing instant finality. On the bottom path, low-value transfers route through the ACH system, aggregating into large batches and settling on a net basis, which optimizes transaction costs but delays finality. Moving money internationally introduces immense complexity. A foreign currency remittance between buyers and sellers in different countries involves two critical risks: the security of the instruction and the credit risk of the paying bank. Because there is no single global central bank, international payments rely on a network called correspondent banking. Imagine your firm in Europe needs to pay a supplier in the US. Your local European bank likely holds a Nostro account, which translates to "our money with you" at a correspondent bank in New York. The European bank sends a secure message instructing the New York bank to debit its Nostro account and credit the supplier via the US clearing system. This chain of correspondent banks requires strict cutoff times and seamless communication. If there is a breakdown in this chain, the payment is delayed, severely impacting your global supply chain and creating unnecessary working capital strains. Here we map the journey of a cross-border foreign currency payment. Because the local originating bank and the beneficiary bank do not share a direct settlement system, they use a correspondent bank in the middle. The local bank funds its Nostro account at the correspondent bank. The correspondent bank receives the instruction, debits the Nostro account, and shifts the liquidity through its domestic clearing system to the beneficiary bank, ultimately crediting the corporate supplier. To solve the security and communication challenge of cross-border payments, the financial world relies on SWIFT, the Society for Worldwide Interbank Financial Telecommunication. It is crucial to understand that SWIFT is a highly secure messaging network. It does not hold funds, it only transmits instructions. SWIFT messages are categorized by message types or MTs. For example, an MT-103 is used for single customer credit transfers, while an MT-940 provides end-of-day customer account statements. Let's look at the sample code structure of an MT-103 on screen. It uses specific tags to ensure universal translation. Tag 20 is the transaction reference, tag 32A contains the value date and amount, and tag 59 identifies the beneficiary. If any of this data is missing, the payment drops out of straight-through processing and enters a manual repair queue, causing severe delays. Today, SWIFT is migrating toward the ISO 20022 standard, utilizing rich XML formats to carry even more detailed payment and remittance data. This block diagram represents the SWIFT messaging ecosystem in an automated corporate environment. The corporate ERP sits at the edge, sending payables data to the TMS, which connects to the SWIFT network to transmit a formatted MT-103 or ISO 20022 message. SWIFT acts purely as the secure data carrier, routing the standardized instruction to the global bank, which triggers the actual movement of funds and returns a real-time execution status. Global money movement is fraught with financial risks that the Treasury must actively identify and manage. One of the most severe threats is settlement risk, famously known in the industry as Herstatt risk. This occurs when one party delivers its side of a foreign exchange transaction, but the counterparty defaults before delivering the other currency, often due to time zone differences in global banking hours. Beyond counterparty defaults, multinational companies face sovereign or cross-border risks. For instance, convertibility risk happens when a government suddenly passes regulations restricting the conversion of its local currency into foreign exchange. Transferability risk occurs when a government bans the outward remittance of funds entirely, even if they are already denominated in a foreign currency. A world-class treasury architecture must map out these specific exposures across all operating countries and establish strict limit frameworks and contingency plans to protect the firm's global liquidity. This risk taxonomy chart breaks down the critical threats in global money movement. From the central node, we branch into settlement risk, which is directly linked to counterparty default and exacerbated by time zone mismatches, leading to Herstatt risk. The other main branch is cross-border risk, which splits into sovereign-driven convertibility and transferability constraints. Managing these nodes requires constant vigilance and proactive treasury governance. Let us examine a real-time use case to address foreign exchange settlement risk, or Herstatt risk. Imagine your corporation executes a massive FX swap, selling euros to buy US dollars. Because European clearing markets close before US markets, you are forced to deliver your euros first. If the counterparty bank goes bankrupt in those intervening hours, you lose your euros and never receive your dollars. The solution to this systemic threat is the Continuous Linked Settlement, or CLS system. CLS is a specialized global institution that settles FX trades across 17 major currencies using an ingenious mechanism called payment versus payment, or PVP. Under the PVP framework, CLS ensures that the exchange of the two currencies occurs simultaneously. If one party fails to deliver their currency, the other party's funds are immediately returned. By ensuring your banks route large FX settlements through CLS, your treasury completely eliminates the settlement risk that could otherwise devastate your balance sheet. This sequence diagram brilliantly illustrates the CLS payment versus payment mechanism. Instead of Bank A and Bank B paying each other directly across different time zones, both submit their respective currencies simultaneously to the centralized CLS system node. CLS holds the funds and securely releases them to both parties at the exact same moment, totally neutralizing the threat of settlement risk. As we conclude our masterclass, we must look to the future of global money movement. Corporate treasury is rapidly evolving from a transactional back office into a digitally native strategic control tower. The industry is aggressively standardizing around the ISO 20022 XML messaging format, driven by the Common Global Implementation, or CGI initiative. This powerful framework allows your company to use a single, harmonized XML template to communicate with all your global banks, drastically simplifying complex multi-bank integrations. Furthermore, by feeding these standardized, rich data streams into artificial intelligence models, treasuries can instantly detect payment anomalies, automate fraud prevention, and predict cash flow bottlenecks before they occur. This predictive liquidity capability is the ultimate goal. Thank you for joining this expert session. I invite learners to like, subscribe, and visit quicktechie.com for premium certification prep, including Q&A banks, full ebooks, audiobooks, full-length training, and interview guides. Our final diagram charts the future architecture of treasury payments. We begin with the corporate ERP, transmitting a harmonized ISO 20022 XML payload via the CGI framework. This rich data flows efficiently into the global banking network and is simultaneously fed into a central AI analytics engine. The engine outputs predictive liquidity insights and real-time anomaly detection, culminating in the ultimate state of treasury design, the strategic control tower.